Have you ever wondered how to build a diversified portfolio that is strong without picking individual stocks? Well, in today's live stream, I'm going to answer your questions and I want to go through and build an actual simple portfolio for our new investors and show you exactly what ETFs that I'm putting in. It's going to be comprised of ETFs. We're going to also have some ETF bonds in there, also some international, helping to spread the risk of the portfolio, really balancing out the growth that we have and helping you really stay on track for long-term wealth. So for this, I am going to use M1 Finance. Now, M1 Finance, I have used for a number of years, building out a lot of different portfolios. I'm going to hop over there. Now, once you go through the verification, you'll notice this is exactly what you see. When you log in, it'll be building your portfolio. Once you verify your email address, you can actually go in here, choose your securities like we see right here. And M1 is based on pies. Now, what it does is regardless of what you put in the portfolio, you will assign it a certain percentage. Getting to 100%, you can even subdivide the pies within here, which I'll show you in here. It's really interesting how they do it because with regular contributions, you don't actually have to rebalance your portfolio. When the percentages of the pies are a little bit different, it will go ahead, it will reallocate itself based on contributions versus going through and rebalancing. So I want to kind of build this out and show you the securities. Now you can see right on this left side, we have stocks, we have funds, we have my pies, so you can create your own model portfolios in your watch list. So you can go in here and they have recommended portfolios, which you can build yourself. You can build your own, or they have, again, recommended those model portfolios, depending exactly what you want to invest in. Now, for me, we are looking at funds. And as you can see, they have pretty much everything in here. And it's interesting because there were actually a couple funds that were not listed on M1 Finance. I contacted them within about a day or two. They said, your fund is now listed on the ETF. So I went in there and I invested in it. And I want to kind of break in and show you a portfolio. Now, when it comes to a portfolio, we want to start with the foundation. We really talk about this from a bigger picture. When you start thinking of a foundation, it is going to be something like the VOO. Now we can go ahead and add this to the bucket of portfolio. You'll see it will allocate 100% in there, and we're going to go ahead and add more to this portfolio. But as it sits right now, that is really the basis. Now there are a lot of variations that you could do with this portfolio. You could invest in the VOO, which is going to be a foundation. You could do something like the VTI. You could do something like the SPY. You could do the VT. You could do a lot of different things in here, which again, I want to go in here and kind of add the slice and show you some of the ones that we're actually talking about when it comes to these funds, because in the top, we can search, like I said, the VOO. This is one, Vanguard S&P 500. Absolutely one that you want to watch, one that I invest in personally. And a majority of the ones that I'm going to show you, I do invest in personally within the ETF. So this is, again, one, Vanguard S&P 500. Like we said, you could do something like the VTI. So instead of just investing in the large cap or the 500 largest companies within the United States, something like the VTI will be the total stock market. So you're looking at about 3,500 different stocks in there. You could do something like the VT, which is the total world stock market. So you're not just getting and staying within the United States. Now you're actually covering every single company within the world, which is kind of crazy. And again, this is going to be the foundation. This is step one. This is the basis of the building block of a portfolio. And diversification really matters, really spreading money and spreading risk across your portfolio. You're not going into a single stock with these. You're not going into a single sector or a specific country like the United States. You are investing into everything. Now, again, for me personally, I do use the S&P 500 or the VOO. That is the one that I use. I know, again, there are some variations. Some people do use the SPY, like I said, a couple other ones, and I have a list of them on my phone. That's why I'm kind of looking down here for kind of that core position. So again, the VOO is what I would add kind of in that core. Now, thinking of what we would do for growth. So we have the foundation, we have the core out of there. So for growth, for me, I do the QQQM. This is actually the Nasdaq. So when you start thinking of a portfolio, the VOO or that S&P 500 is going to track the S&P 500. The QQQM tracks the Nasdaq 100. So this includes all of your tech companies, but it excludes financial companies. So this could be, again, your big growth factor. Now, when it comes to the growth factor in general, there are a few different ones that you could do. QQQM or the QQQ would work incredibly well. We look at like a VGT. This, again, information technology, very similar when it comes to investing in that tech side. You could even look at something like the VUG instead of the VGT, which again is going to offer you a lot of the growth, very heavily focused in the tech sector. Now with this, it's going to make a difference, and we're going to break out kind of the different buckets in a little bit, showing you where you should invest and how you should invest or how you should allocate, because it makes a big difference based on age. Where I feel like if you're 18, 20, 25, you're going to be putting a lot more into something like the QQQM or the Invesco, something that is going to be a lot more growth and a lot more heavily into those growth ETFs versus something being a lot more conservative or a lot more foundational like the VOO, or again, thinking of what we have kind of a dividend focus or growth focus, which is the third part of the portfolio. For most people, they choose the SCHD. This is one of the absolute most popular ETFs that we have really worldwide. The SCHD has been incredibly well known. Over the last couple years, however, we have actually seen this underperform considerably when it comes to the actual dividend equity growth. When it comes to this ETF specifically, the growth really hasn't been there. Dividends, it runs about 3.7, so it's going to be a lot higher than the VOO. It's going to be significantly higher than that QQQM. But overall with the SCHD, even though it has the growth factor or the dividend factor, you're looking at the quality companies. You're looking at your blue chip companies. Think of your Coca-Cola, think of your PepsiCo, Home Depot. These are going to be the income component of this portfolio, which makes up a really big trio. Now, this traditionally is what we see, and we'll go ahead and we'll add this to the basket. Now, the next part that I really want to talk about, but before I get into there, I want to answer Wayne's question. So he says, I'm looking to retire or looking to increase my income over the next 10 years. I have BTCI, BETH, and then WPay. I'm hoping WPay is going to be a winner. Now, I have some concerns and I have some questions when it comes to a question like this. Wayne, is what percentage of your portfolio are you putting into these? Now, the reason why I ask this is when it comes to like your NEO funds, when it comes to your Round Hill Tree funds or your Round Hill funds, I do own the XDTE and the QDTE, so I know exactly what you're investing in. I also do have the NEO funds with Misty and a couple other ones that I've seen out there. The question that I have or the issue that I have with some of these is, one, these ETFs and these covered calls or these option covered calls are very, very new. Most of them do not have a track record at all. Most of them have only been around 1 year, if 1 year. I'm even thinking of like some of those XDTE, QDTE that I hold. They've been around, I believe it's going just on 2 years. Track record for them have been incredibly, incredibly strong, incredibly stable with the income generation that you're actually getting. But a lot of people are worried about NAV erosion and worried about what is it going to look like when it comes to the long-term investing of these ETFs, where it seems like NAV erosion for some of those can go so fast that you're going to lose a majority of what you have in the ETF. I know you do get some of it back in income, but they're worried about the NAV erosion with a lot of these ETFs. And I feel the exact same, where we could burn through a lot of the value of these ETFs. And again, with them being so new, we don't know exactly what that's going to look like long-term. It's going to be interesting when we get 3, 5, 10 years down the road to see exactly what these ETFs are performing. Because when you think of something, and again, thinking of like the covered calls for Bitcoin, thinking of the MSTY, which is yielding about a 95% distribution rate, which is incredible, burning through the NAV and burning through the value of the ETF itself. Again, it's going to be interesting. It's generating income and generating a lot of income in a very short amount of time because you have it tied to Bitcoin and you have it tied to strategy. So two incredibly volatile assets that we have. And again, I don't know how much it's going to be. I don't know how much the depreciation or the NAV is going to do, which we mean by that is you put $100,000 into the ETF, you start getting all these distributions over the course of the year. 50% of the value of what you put in, or roughly $50,000, is completely gone based on the value because you're not giving away the growth, or you're not getting the growth because you're giving it away through options. Now, the catch with this is when it comes to some of these, like these Round Hill ETFs or the NEOs, is you don't have a downside, or you have kind of an unlimited downside. There is a very limited upside based on the ETF itself and based on the options, because you're selling the options to get and generate the income, which means you're not seeing the growth of the ETF. But again, on the downside, where if there is a downturn in the market, I feel like these ETFs, even thinking last year or two, are going to get absolutely devastated. If there is a strong downturn, I'm talking, 10, 20, 30% in the market, you might see an even further downturn with these because of the NAV erosion that's already been built in. So thank you for the question, Wayne. Definitely be very cautious. That's why I have a very, very small percent of my portfolio into the things of that nature, where, I'm talking probably 10% of a portfolio or less. I know it's great to get the income, but you could possibly just be burning it on the back end because of the NAV erosion that we have in there with the income that is generated in there. So again, thank you for the question. So getting back to our portfolio, guys, let's look. And this is another one where I kind of question. So looking at like the BND, which is a total bond market fund, this is where myself and the financial advisors that I work with are not really in step and not really hand in hand. So my thought, bonds or stocks tell a specific story when it comes to the company, but they say to be diversified, I need to own two things, which in my portfolio, I do not own. One is bonds. I do not carry any bonds in the portfolio. And the other one is global exposure or international ETFs, which again, I do not hold in my portfolio. And my thought and my logic and my reasoning, and I don't know if any of you share this, is when we start looking at companies. So think of some of the larger companies. When I think of like Apple, I think of Microsoft, I think of NVIDIA. When I start thinking of these larger companies within the United States or even outside of the United States, almost every single company has some sort of global presence. When we start thinking of Coca-Cola, they're global. They have Coke in pretty much every country in the world. When you look at Pepsi, when you look at, Johnson & Johnson, when you start looking at these companies that are in the S&P 500, that are in the total United States market, a majority of them are global companies. And even looking at the bonds, when we look at the returns, and this is where I kind of want to break it out, because when we look at a 5-year return on the bonds, the total bond market in the last 5 years is negative 15%. Think about this for a minute. Think of the growth that we have seen in the last 5 years. And my thought, and again, the way that I kind of logic this or talk about it, is I choose not to invest in bonds. I would rather have something and have a little bit more percentage into something like the SCHD that has a little bit of growth, maybe not as much as we would like, and does offer a pretty good yield at that 3.7%, versus having the bonds, which again, over the last 15 years, we have seen a negative, or excuse me, last 5 years, we have seen a negative 15% in the bond market. I feel like bonds have underperformed. And even when you go out even further, the bond market, when you factor in inflation, has very, very, very poorly underperformed. Even looking at another bond fund, again, that we've kind of talked about, is going into the AGG. So let's look at this one, guys. This one, again, is another bond fund that a lot of people do talk about. It is the U.S. Aggregate Bond Fund. And again, thinking of this one going back the last 5 years, boom, down 15% again in the bonds. If you're investing in the VOO, if you were investing in the QQQ, even if you were investing in the SCHD, you would have and beat out inflation, also have the growth factor in there, looking at some of the stability within dividend income or even the tech-driven growth and the stability within all of the sectors like the VOO. That is the reason why I choose not to invest in the bonds at all, just for the fact that they have notoriously kind of underperformed. And if you're thinking, again, in a portfolio, maybe if you're at the point of retirement or maybe even during retirement, but even during that time, I again think something like the SCHD would be a very good bet versus going in and investing, 5, 10, 15, 20% into your portfolio. And the other thing to remember is with bonds is that if you have a 401k plan, if you are invested into target date funds, they have a tendency over the life of a target date fund, they move a lot of money into bonds. That again is another reason why I feel like, and there's been a ton of articles that have been published within the last few years where if individuals stayed invested versus moving into something like the bonds. You would not have run out of money during retirement, but because they were in an asset that wasn't growing, being eaten up by inflation, or you can see the negative returns in the bond market, they have really underperformed if they would have just stayed invested. Meaning, if we stayed into the VOO, into the QQQ, into the SCHD, we would have grown a portfolio to a size that we would be able to maintain everything through retirement. But because a majority of the portfolio in target date funds, again, kind of do fall into moving into a lot more of the bonds, you generally, and some people, depending on the size of the portfolio, run out of money during retirement. And I think about this because when you look at an average portfolio of an individual that's looking to retire, and I believe the average right now is around 180K. If you have 20, 30, 50% into something like this, it's not going to perform, and it's not going to perform the way that you want. And I always think, general rule of thumb, where if you retire at the age of 65, and let's say you pass away at 95, so you have a 30-year window, which I'm not saying ultra aggressive. It should be in cryptocurrency and Bitcoin. But I'm saying when it comes to investing in still needing, 20 to 30 years of growth in a portfolio, shifting half your portfolio into bonds, or I've even seen, and God help them for sometimes it really frustrates me. I have seen individuals that are invested in the market. They get ready to retire. They take out their 401k plan in the entirety. So even, $100,000 to $300,000, that 401k plan comes into a financial institution. Now, I've worked at banks. I've worked at credit unions. I love both sides of the equation, but I have seen people move their entire 401k balances into a place, like a regular bank, and it is set there in IRA accounts, earning a 0.4, 0.6, maybe even a 0.05, and they have parked the money during retirement because they left their institution, their organization, or wherever they were working, moved the money over, and then it has sat at a financial institution, not even earning 1%, which is absolutely devastating. I always say, if you're moving money into an IRA, it has to be invested. If you're putting money into a 401k, it has to be invested, and it has to be invested properly, or you are going to get absolutely burned. You are never, ever going to see the growth that you need to get out of that portfolio to have a chance at retiring and having and really living your best life through retirement. Really makes a big difference. Now in here, like I said, I'm going to go ahead and I'm going to add my bonds in here because that's what it always tells me. I, again, get so much flack from financial advisors because I do not like the bonds. And then even looking something like the VXUS, which is the international stock ETF. This again is something, when I look historically, last 5 years up 37%. Majority of things are up considerably higher than that, but offering some diversification if you wanted to get into international. But again, when you start going back even further in the last 5 years, the growth we have seen in the US markets has been absolutely phenomenal. Not saying it's going to continue forever, but I choose, again, not to invest in bonds, and I do not invest into international ETFs at all. And again, when it comes to international, I am not familiar with a lot of the companies. Some of them, of course, I know, but doing the research on the different markets, the ins and outs, everything when it comes to international, this is, again, another part that I do not choose to invest in. But for this portfolio, I want to put in the global exposure and kind of show you how it all goes together and where it does go from there. So let's go ahead and add these in the portfolio. Some already exist. So it kicked out my pies. So it did kick them out. Let's go ahead. Let's delete this one. And I'm wondering if it's going to let me, let's go ahead and exit it out of here and see. Oh, it's not going to save any of them. That's okay. We can drop them back in here again. So we'll go with the VOO. And I like when you go in here. And again, this is through M1 Finance. So if you have ever used M1 Finance, it works incredibly well. This is where I use M1, and I do have Robinhood as well. So these are actually a few that I do use personally. And if you caught some of my other videos, I do have all of these portfolios out there that I kind of build. So BND, that was our bond fund that we were adding in here. And then, of course, international when it comes to like the VXUS. And these are just general funds. Like we had said before, you can go in here, you can add a bunch of different funds in here depending what your target is and depending what you really want to build out of there. And before we hop in and we build out kind of the portfolio, what do you think of the SPMO for growth ETF? Who is that actually through? Let me save this and let me hop back in because we can add a couple more in here. But there we go. So there is our portfolio. Again, we're going to edit this in just a minute, but I want to take a look and continue looking in here. And I think it will let us go back into what we're kind of building here. I might have messed it up a little. There we go. So let's go ahead and add a slice. Let me check out. And I love in here because you can do a ton of research. It has all of your ETFs. It has your watch list. But going in here and looking at the SPMO right there. So the Invesco Momentum Fund. So interesting enough. So this was one that I was invested in a while ago. When you look at this, the last 5 years, 150%. And I believe if I remember from this fund, trying to think it from memory, that they only put funds in here that have the ability to increase over a certain percentage. Like I remember this a little bit when they're investing into something. And again, when you think of a growth fund, something like this, it will work incredibly well. Let me see, because I think it will also break it down here. When I look at what it exactly is, yeah, see NVIDIA, Meta, some of the big tech companies out on there. But let me see, because I believe it will. No, see, this is going to take me to the SEC. We don't want to go into the SEC. Let me get out of here because, again, I don't want to go in there. But I thought it broke it down a little bit further on here. Maybe if I look at the actual ETF itself to break it down a little bit further and going into what exactly is going on with the ETF itself or what it's invested in. But again, anything that is related is going to make a big difference depending on how much you put in there. That again, that is one of the big things, Harrison, that you have to remember is when you look at growth and thinking of, again, let's go ahead and close this out because I want to show you the edit in here and what we're kind of looking at. So here we have the pies itself. So we have the VOO, the QQQM, SCHD, the BND, and of course our international, which again, my personal preference, I do not invest in the BND. I do not invest in the international. I really don't like either of those. But thinking of a portfolio and thinking of what you would break this into or kind of how you would segment this out depending on your age. So thinking about a younger investor, and we'll start, let's say you're 25 years old, just graduated from college, you're out, you're getting your first job. Honestly, thinking of the growth factor. So if you're 25, you retire at 65, you have a 40-year window. At a 40-year window, I would almost put probably 50% into something that is going to be very, very heavy growth. Something like the QQQM, something, like a growth ETF. And again, there's a lot of different growth ETFs out there, depending what you want to put it into. Me specifically, I like the Nasdaq. You could do the VUG, you could do the SPMO, you could do, the VGT. There's a lot of different ones in there that you could go in there and actually build for growth. But again, younger investor, 25 years old, you want a lot into the QQQM. You are looking at a 40-year window for growth. If you want to keep something like the SCHD, maybe 20%, probably 10% would be good because this is going to make a big difference when you're growing this portfolio. And essentially the plan or the logic behind it is you want to build this portfolio and you want to build this portfolio up for at least the next 20 to 30 years through regular contributions. Even like I said, for me, the BND, I probably wouldn't put anything in there. Even looking here in the international, I probably wouldn't put anything in there at all at this age because you're not going to see the growth out of the bond market. You're not going to see the growth. Well, you could see it out of international, but again, I don't prefer to invest in international. Even thinking of the SCHD, over the last couple of years, you're not going to see a lot of growth out of there. And I would even consider going in here and looking for something. And again, this is kind of my personal preference, doing something around Bitcoin. Even looking at the BITO, thinking of the BIT, depending what you want to. And again, do your own research when it comes to this. Just knowing, because I believe it's the IBIT. I think the IBIT is the one that I actually do hold. So adding that basket, adding it to your portfolio, again, thinking of an individual that is younger, even putting in a couple percent. Right now, when you look at all of the larger companies, when you're looking at your BlackRock, your Vanguards, your Fidelities, they are saying you should have exposure to Bitcoin and Ethereum or cryptocurrency, and they're saying roughly 2%. Now, again, if you're familiar, and I do not advise anyone investing into Bitcoin, anyone investing into cryptocurrency, if you don't know what you're investing in. And generally, guys, that is really and runs true for anything. Do not invest in things you don't know what it is. It is imperative. You have to know what you're investing in. If not, you can get completely burned not knowing what you're investing in. But again, looking in here, if we put maybe 2% into Bitcoin, 4%, 6%, again, it's really depending on your choice, your exposure, and what kind of risk that you're willing to take. Because even if I go in here and I minus out some of these, they're pending, as you can see, because we're not putting anything in there. Me personally, I have 10% in Bitcoin. If you've seen my portfolio, I really do believe blockchain technology. And again, thinking kind of bigger picture, we have all of your major investing houses that are going to be buying Bitcoin or that have already bought Bitcoin. We have the United States government that is going to be buying Bitcoin. Even when it comes to Ethereum, there are so many people, institutional investors that are buying in Bitcoin. They're going to have to continue buying Bitcoin regardless of the price, for the simple fact that when it comes to Bitcoin, they're going to have it in the portfolio. If you have individuals, and again, thinking of what President Trump passed, knowing that alternative assets are going to be coming to 401k plans, if your 401k plan wants to offer something like Bitcoin, they're going to have to own the Bitcoin to offer in those ETFs, meaning you could see this thing really grow sky high just for the fact that they're going to have to get the Bitcoin from somewhere to offer all of these alternative assets in there. So again, thinking of someone that is younger age right there, even if we went a little bit more, probably the VOO, I would put another 10% in. So again, 25 years old, really invested into growth, have that 40-year window. You have 30% into the VOO, which is the foundational. And again, there's a lot of variations, the VTI, the VT that you could use in place of the VOO just as that foundation. Then you do have the income generation like the SCHD. And again, this could be a really good portfolio right here. We could create the pie. We could name it whatever we wanted to, but this would be an honestly regular contribution. So think about it for a minute. Based on here, if you're putting $100 into this portfolio every single month, you're going to be investing a majority of your money, 50% of your money, into tech. So it is going to go into the high growth. It is going to go in that high tech sector. That is where you want your money to go because you have a 40-year window that is going to grow. However, you still have another $30 of that, or 30%, going into foundation, into the S&P 500, still going again, a little bit of overlap with those tech companies, but now you're getting exposure to your utilities. You're getting exposure to all of the sectors in there, including the financial sectors that are built in the VOO. In the SCHD, you're picking up all of your blue chip companies. That is kind of the income generator that you can get out of the SCHD. And then you also do have that exposure to Bitcoin in there. So you have your exposure to cryptocurrency. Now, as we go on and as we age, so again, looking at this portfolio, I feel like it would be a really good, solid portfolio for someone that's 25, making regular contributions in there and wanting to have the growth. Now we fast forward, and let's say you're at 45. This might be a point where, you back it off a little in the growth. You're now 20 years or 20 years later. Honestly, I think Bitcoin would probably be good there. Maybe putting a little bit more into, again, kind of being more conservative, putting more into the SCHD, even, backing it off a little bit more in the growth, but you're going to see something that you're still going to be able to have a considerable amount of growth. You're going to have some of the foundation in there, which is really cool. So again, thinking of here, you're not going to be out of the growth. You're still going to have 30% of that going into the growth ETF. You're going to have a little bit more of the stability with the foundational. You're starting to generate a little bit more income with the SCHD. Now, again, when you think about this, from the ages of 20 to 45, you have had 20 years of contributions. You have had 20 years of growth in this portfolio. So you might have taken a portfolio that you just started with that $100 at 25. Now you've grown it over 20 years. You're looking at $100,000 plus. When you start allocating more into the SCHD, you're going to have a much larger portfolio to essentially build into, and as you make contributions, continue building into. QQQM, the VOO are going to continue to run, going to continue to grow. And you also have to kind of step back for a minute, because we know the market's going to have ups, the markets are going to have downs. You're thinking about this from a 10,000 foot view, meaning this is going to be measured on 5-year timeframes. When you start getting into what did the market do this week? What did the market do today? What did the market do this month? If you're really that focused on the portfolio, that kind of pigeonholed into it, you're never going to see exactly what you need to see. That is why, again, I measure the market and we say when it comes to investing, you have to be investing for 5 years plus. When you start looking at the market at 5-year chunks or even 5, 10, 15, 20 years, the growth factor comes in there. When you think of something like the VOO, it averages right now a little bit, right around 10% per year on average. So again, you're thinking 20 years, you're getting a 10% return on average over 20 years. QQQM, I believe, was around 16%. SCHD was considerably lower. I think around, I want to say 8 or 9%. But when you add in the dividends, it was a little bit higher. And then, of course, Bitcoin has been kind of all over the board, been doing and absolutely crushing it as of recently. So again, this portfolio, changing it up a little bit, still got your 10% in Bitcoin, a little bit more conservative because you have more in that Vanguard, that S&P 500, and still starting to generate a little bit more revenue with the SCHD. And this is kind of what I did with my portfolio. Then again, we go from 45 and let's forward up to 65. So again, we want to get some growth. We still want growth out of this portfolio. So even if you put 20, 25% into growth, remember, 65, if you're retiring at 65, you're completely done. You still have roughly 65 to 85 or 95. So you have another 20 or 30 years of growth in that portfolio that you need to get. And this is the point where, honestly, putting a little bit less into, let's say, the VOO, great. Putting more into the SCHD because now we're retired. And you can get and build a portfolio to the point the dividends that you're getting out of the SCHD is going to be enough to cover and supplement Social Security, which is exactly what I plan to do. So when we think about the SCHD and thinking of the dividends, this is going to be the point where your portfolio, and again, thinking of 40 years, regular contributions, $100 a month, your portfolio could be sitting at $200,000, $300,000, $400,000, $500,000. Meaning if you have 30% of that portfolio, a $500,000 portfolio in the SCHD, you're going to get a pretty good return. When you get the dividends out of here, you're still going to see roughly 50% growth out of the VOO and the QQQ, which again is going to continue growing that portfolio all the way through retirement. Now, again, I know a lot of people say, hey, we need to put some into bonds. Honestly, you don't. And just looking at, and again, catching flack from my financial advisors, if you're putting a lot more money into the bonds, like we just seen, over the last 5 years, it was negative 15%. Even looking at international, again, I don't really put anything into international. In thinking of the portfolio, like I said, with the generation, still going in Bitcoin, and now we're fast forwarding Bitcoin 40 years down the road. You never know. This could be $1 million plus portfolio with the regular contributions. Now, also remember, this is just kind of based on that $100 a month. So when we started at age 25, we were putting in $100. Then, you continue on, you get your company match, you're putting in a couple $100 or even getting to the point where a couple $1,000 are going into this portfolio through regular contributions. You could have $1 million portfolio very fast. It is just the earlier that you start this, the better and the higher it is going to perform. And honestly, that is one of the biggest things is contributions. Like we've said before, when you look at someone who is 20 to 30, you do 10 years of contributions, $100 a month. And then you have a person who goes, 30 to 60, they put that same $100 in there. The person who invested earlier is going to have a lot more money, which is kind of crazy to see. Let me hop in and answer another question. So right down here, another one from Harrison. 401k plan allows us to put our money in a self-directed account. This will enable me to buy most ETFs and stocks. So when I'm down like 50, 60, I can move some of it into money. So the JEPQ, the JEPI, there's a lot of different versions of the JEPI. Now, again, you have to be concerned. You have to be aware of them and knowing what income you're getting and what growth. So that is kind of the trade-off. So even thinking of, like we were talking about earlier with BTCI, even looking at the WPay, like what Wayne was talking about, there are a lot of ETFs that are going to offer you income, like the JEPQ and the I think it's the JEPI. There's a couple in there, and you can build some really crafty portfolios with that being a smaller portion of the portfolio. Where even here, so thinking about the SCHD at 30%, let's say even for instance, you turn this down and let's say this is at 20%. So you have kind of your income rate there. You have kind of your foundational income that we have with the SCHD, and you add in something like we've seen right there, you add in something like the JEPQ that is going to offer you a higher yield, offer you higher margins, higher return, higher dividend yield. That again is something you can kind of play around with it, Harrison. But it's interesting because you have to know what is the return that you're getting versus the growth that you're giving up. So that's why we were talking about a lot of those NEO funds, a lot of the Roundhill funds that are just kind of burning through the NAV erosion because they're offering income, and they're offering income on a weekly basis. You have to be conscious of what does the growth look like. And again, a very small percentage of the portfolio to generate some additional income during retirement makes sense because, and again, this is something that you're going to have to reevaluate when you retire. If you retire and let's say I'm 65, I retire, I have no car payments, I have no debt, I have no mortgage payment, I'm getting Social Security on a regular basis. What is my burn rate? Now we've talked about the burn rate before. So that means when you start looking bigger picture, how much money do you need on a monthly basis? How much money do you need on a annual basis to keep everything afloat? Do you have any larger expenses coming up? Are you going to be taking vacations? Is there going to be, and how do you outpace your burn rate? Where again, you could think of something like the SCHD, the JEPQ, the WPay. What can you generate enough income on a monthly basis that your investment portfolio is going to produce enough funds to outpace your burn rate, meaning that your investment portfolio is still growing, you're taking money out of there and not on a regular basis? Because I always live to, and I want to get to the point of Dave Ramsey where he always talks about never touch the golden goose, meaning if we have a portfolio and let's say we have $1 million in our portfolio, that we can take a certain percentage off that portfolio every single year, and it's not going to affect the $1 million we have in that portfolio. The portfolio 100% is going to stay intact, meaning we can take the dividends off of something like the SCHD. We can take the dividends off of some of these option covered calls ETFs and generate enough income to supplement Social Security, meaning we still have money at the end of the month that we can invest above and beyond what we're actually taking out of there while never touching the original portfolio. That is how, guys, simply put, you create generational wealth. It is very, very easy at that point where when you're going through, if you're leaving your kids or getting to the point of a $1, $2, $3, $5 million portfolio, for a majority of people, you're never going to be able to even spend what you're getting from the dividends out of that portfolio or the growth out of that portfolio. It gets to a point where money almost becomes non-existent because you're generating it so fast with a portfolio. And when we even talk about like the dividend snowball, it works in the exact same opposite versus the dividend snowball is you actually have, or excuse me, the debt snowball, you have a dividend snowball where the money is coming in so fast. With the SCHD, you're not burning through it as it's coming in. Very interesting to see when it comes to retirement. And again, exactly what I want to do. So, all right, guys. So to sum it up, wanted to build a portfolio with you guys and show you how easy, because even if we went in here with this, we can create our pie. We can go ahead and name it. We'll just do live stream. Why not? So we'll go ahead, we'll add that pie and it will build it into the portfolio. Or no, that's right. Adding or creating a pie, I can subdivide everything like we were talking about before. I can go in this pie and add in other pies in here. So I can actually subdivide, because let's say within here, my subdivided pie, I could go in here and add 10 other ETFs. And then when we go into the other part, we could build and go in at that subdivided pie and put in another, again, 5, 10, 15 ETFs, which could be 2% of the portfolio itself. And again, you could kind of break it down with an income pie. You could build a part like that where I could make something that is income generation. I could make that 30% of the portfolio, like you just seen us do with the SCHD. But then you could also put like a JEPQ in there at 2%. You could do like a WPay in there for 2%. You could subdivide, again, all of those within that portfolio itself with creating this. Like if we did income, we could go ahead and add that. we could break this out a little bit. So SCHD, we take it down 5%. Let's say we add 5% in here. Then we could go in and kind of subdivide everything that is in that pie that could make up, just like we're talking right there, 5960, going into something like the JEPQ, is you could go in and you could subdivide it in here through M1 Finance, meaning 5% of my pie, when I go in here, might be 10 different slices or 5 different slices at 1% each. I have about 30 years to go between my employer and me match. I maxed out the 401k, which is absolutely amazing. Doing the VOO, SCHG, QQQN, SCHD, and Berkshire Hathaway. Really good. I mean, honestly, so you're invested, you got the foundation, you got the growth in there, you have the SCHD. Me personally, I dropped the SCHD not too long ago, just because I feel like the last 3 or 4 years it's kind of been underperforming. But again, depending on the percentage that you're using in there for the SCHD, Harrison, it will work incredibly well. And Berkshire Hathaway this year, for Berkshire Hathaway, with the announcement of Warren Buffett retiring, I know has been absolutely devastating. With it kind of pulling back quite a bit, I feel like that's going to be an interesting one to play. But honestly, I've talked about it before. If there is like one single company that I would own if I bought individuals, it's kind of interesting because with that, Berkshire Hathaway is one that I would consider, but I choose, and the only one that I do, if you checked out my portfolio, we're putting $10 a day into NVIDIA. Again, I know, and a lot of people might say, oh, it's too late for NVIDIA. Guys, it's going to run. It's going to grow. The tech is not going anywhere. And NVIDIA, if you look at their earnings, they make an insane amount of money. When you start thinking of a company, all the research, all the development, everything else they do, that is really the only and one single one that I do invest in is NVIDIA. And again, it's something that I'm going to do my 30-day update pretty soon, putting $10 in there every single day and just letting it run. It's a fun account to have over on Robinhood, and just kind of going back there in the entirety. It's pretty cool to see just where it grows and where it's going to grow in the next couple years. You said you had SPMO in the past. No, the SCHD. So I dropped the SCHD, Mr. B. And the reason being, when we look at the SCHD, even let me pull it up over here. It was kind of interesting because the overall return on the SCHD, the SCHD was a little bit lower than what I wanted to see. Even thinking, I can bring this back onto the stage, but looking at the SCHD, which is interesting because you can see over the last year, it's down about 0.13. Over the last 2 years, it's up 11. And then even the 5 years, it's up 46. When you start doing this in comparison to the growth, that's why I feel with the SCHD, it's going to be super beneficial. And this can be something really good as you're closer to retirement. When you start looking at really the consistent growth, when we start doing like ETF.com, when you look at the comparison on the SCHD, even the total return has really underperformed for the last couple of years. And I feel like that has a lot to do with the reconstitution. When they did the reconstitution this year in 2025, and I believe they do it in March every single year, it went into a lot of healthcare. Healthcare has really, really been underperforming, and it went into a couple other segments, which I do have an SCHD video that is coming out, because when you look at what it reconstituted to, it is concentrated around 60% into 3 different sectors. All 3 of those sectors are not performing very well, which means if you had it invested elsewhere, you would have seen a lot more growth than we traditionally would have seen with other ones. So I feel like, again, having a 20+ retirement runway, putting more money and getting it to grow a little bit faster, a little bit bigger with some of the revenue that's coming in or some of the dividends that are coming in, I feel like I really need it to grow. And then I can systematically move percentages into that SCHD as I get closer to retirement to supplement the income in the entirety. So yeah, Berkshire Hathaway Accident ETF. Yeah, I know it's a company. The holdings in there are crazy with the amount that they hold. And I know Berkshire Hathaway also owns Geico, and they own a bunch of other things that kind of fall under the umbrella. Yes, Berkshire Hathaway absolutely acts like an ETF in its entirety because it owns, a crazy amount of things within there. Again, kind of acting like, his own self-built ETF is what it is. And I was super sad when I heard he was going to retire. Also, when Charlie Munger passed away, I've been following those guys for many, many, many years. And it's always cool. All the quotes, everything that they brought us. And honestly, probably one of the biggest, one of the best investors that we've ever seen. And honestly, it took time. That's it. So when you look at his wealth at 65, and then you look at Warren Buffett, and you look at his wealth when he was 95 or just about 95, when you look at the exponential growth, the returns, and I think his return on average is around 23%, which is absolutely crazy, just crushing, over doubling the S&P 500, even over and really outpacing a lot of our tech ETFs. It's incredible to see how well he has done over an extended amount of time. So, all right, guys, so to sum it up here, ETFs, absolutely one of the best tools when it comes to diversification. Handful of funds, you can do the VOO, you can do the QQQM, you can do the SCHD. That is going to be and give you diversification amongst the portfolio, giving you access to thousands of companies, and it's going to be mixed growth, income stability, which we look at, really building out the portfolio. So guys, it's awesome to be able to come and talk to you guys. I want to try doing live streams more on a regular basis. If you got any comments, and I love when you guys give me comments out there, because we can kind of learn together. This is one of the big pieces for the educational side. I've been investing for, God, since I was 18, 19. And if you remember, just old school story, I used to invest with Invesco, and they did it through the mail. So you got perspectives through the mail through Invesco, and you had to send them checks. That's right. If you're a younger generation, the checks are what we get from financial institutions. But if we wanted to invest, we had to send them checks through the mail to invest, and then they would send us a receipt through the mail. It all went through the post office, which again is kind of crazy to think way back when. But yes, everything came through the post office, and that is how you invested. It's not like you walked into a place or you hopped online, you got onto M1 Finance, or you hopped on Robinhood, you had an app. Way back then, it was kind of, and it was all through the mail through Invesco. And it was interesting because you would do it either over the phone, and they would send you the prospectus in the mail. It was kind of crazy. So guys, if you found the video helpful, if you found the live stream helpful, definitely hit the like button, subscribe for more investing breakdowns. We are doing new videos every single day on here. And let me know what ETFs you're investing in. I love to see the SPMO. I love to see, even some of them like the QQQN. There are so many variations of that Nasdaq 100 and really looking at the S&P 500, a lot of different ways to invest it. So guys, that's going to do it for live stream. Let me know what you guys think. And as always, thank you guys for watching.